Let's bring in Rohit Srivastava, fund manager at Sharekhan, who's with us right now. Sarvendra Srivastava will be with us, so will Neeraj Diwan in about 2 minutes or so. Rohit, let's start with you. Good morning. Great having you with us here in the studios. So you were sounding quite bearish the last time we caught up. How's the market looking to you now?
Nothing changed on the larger degree front. In the short term, in the very short term, I think what we are not getting is we are not getting a lot of volume on either side. When the market moves up, we are not really seeing a lot of buying volume. When the market moves down, we are not really seeing a lot of selling volume. So in some kind of deadlock, and that often breaks with some kind of event, whether some kind of external event, So the market's waiting for something to, help it decide which way to go. There is no change in terms of the indicators, the setups at the broader level being bearish. But in the very short term, you would like to see some momentum on the downside gain for you to actually get the move. So
last time we spoke, the index was what, close to about 5350, 5400.
That's right. Just 100 points higher from there. So not really gone far. I mean, 5600 is one important resistance because we made multiple tops there all through February and March. And even recently we touched that and we've dropped from there. So I think unless you go beyond 5600, we're probably topped for the short term. We've still not gotten speed on the way down, which is why some of the analysts would probably consider an alternative. Many are that, you would take support near 5480 and go to maybe 57 or 5800 in the short term and then only fall. But I am keeping it open because I don't know, the setup could even sell off from 5600 because that's an important resistance. So unless that crosses, my bet would be it's going to fall from here. The speed may have been slow in the last 2-3 days, but it will gain momentum as time goes.
We were just looking at talking about volumes. Yesterday, NSE cash market volumes were the lowest since July or something last year, 2010. What does it indicate to you? Two ways to look at it. One, the market could fall very rapidly. Second, because volumes are so thin, on any day, say the market falls about 100 points, 150 points in a day, and you're expecting a follow-through move, it might not happen because the volumes are thin. So you could the big push-up could also happen pretty significantly in a very steep kind of way.
A couple of things have happened. That means one, there are no positions in the market. If you look at the FNO position, or if you try and track the amount of funding positions that are out in the market, you'd probably see that positions are low in terms of speculative positions. Second is flows are slow in terms of mutual fund and NFI flows versus what they used to be before. So these things have actually affected your volume. So what are people looking for? There are negative cues. The people who sound bearish are actually not really selling if you look at fund activity because they see valuations. On the other hand, you're not seeing buying at the same time because people are so scared that they're not putting money in, or they're looking for some kind of trigger, to be sure. So that's causing the lack of volume. So you're really going to, like I said, you're going to need some, when you get this kind of a situation, it usually takes some kind of trigger, whether it's external, global, I don't know what, to actually break the mindset in terms of action. People need to act, and that's when you'll get the volume.
So speculation is out, so nobody's really punting on a big market direction, invest, fund managing. So basically it's a pretty thinly traded, interest is pretty low.
Interest is low, yeah. That's the deadlock. You'll need a confirmation on the broad theme. Say, for example, if I build a bearish theme which is saying the global markets are weak, you have problems in Europe, okay, and on the domestic front, you've been making lower tops ever since November, and that has to play out. So something more negative has to happen. Okay. At the same time, the guys who would think positive are thinking valuations are low. You're at X, 13x or 14, 15x 1 year, 2 years down the line. Why shouldn't this be a buying point? And they are not really getting any fresh triggers from the domestic side to really be aggressive. So that deadlock needs to break with some kind. It would be a sentimental move which would actually drive sentiment one way or the other from here on.
What's slightly baffling to me, and I'll get Rohit's views, is that, when we're talking about events not being there, there have been events. If you're looking at, say, the global sphere, there have been clear events suggesting that there is a change in direction. Global markets have changed direction, right? US markets have changed direction to an extent. Domestically, there have again been events, whether you're looking at the political scenario, whether you're looking at the economic scenario, there have been events, but the market...
You mean Baba Ramdev?
I mean, whatever you want to call it. We call it, sort of
no,
political
from a global
logjam.
perspective, I think 2008 was such a loud event. Then after that, a lot of these events after that have been kind of...
But you'll probably never get something like that. That doesn't mean the market should... I mean, the market seems to be in this inertia. It's not reacting to anything. It's not reacting to global markets. It's not reacting to commodities anymore. And even domestically...
See, so people are not able to price in whether there is any risk in the market, which is what is reflected in your IV. Your IV implied volatility is at the lowest point in years. Okay. And the reason for that is that people are not able to judge whether these risks are real. Because it's taken so long, the belief is built that nothing can go wrong, and that's where you actually need something to go wrong for people to believe, oh yes, something is wrong, and you price in risk, even though the index is down from 6,000 to 5,300. IV is still at 18% or 17%, which is an extreme low level.
We've been chatting with Rohit Srivastava, getting initial comments out from him about what he makes of the market. Let me get in Neeraj Devan, Director at Quantum Securities, who joins in. Sarvendra Srivastava is with us as well, Technical Strategist at Emkay Global. Gentlemen, thanks all of you for being with us here on this edition of Opening Moves. Let me focus my energies here first. So we've got two charters here on the show today, and both Rohit and Sarvendra, by the way, have worked together, are great friends, but the market view differs right now, right? Rohit is saying that market's looking eventually bearish. You're saying a couple of months down the line, you might get a big break.
Yeah, so basically the difference is very thin. There's a very thin line of difference. What we have been maintaining at NDTV over the last 1.5 months is that, in fact over the last 4 months now, is that you break the monthly mean. Bull markets usually don't break below their monthly mean. So once that breaks, I am with everyone to go and short this market till 46, 47. But till the monthly mean is not getting broken and the range is getting contracted. So the range itself is from a 52 to a 58 kind of a band. You are now absolutely now at a 54 to kind of a 56 band. 54 being the monthly mean and 56 being the 200-day moving average. So within this 200-point range, essentially you don't do much. Or you just trade with 30-40% of your capital. And then you could be long or short. In either of the cases, being a bull or a bear.
But your bias is still being long.
30% long. I would be doing 30 to 40% long.
But Rohit is saying you might get a bounce, but essentially you're going a lot lower. Your bias is bearish. It's not a thin line. It's probably diametrically opposite. Depending on what the market does, right?
Looking at a pure view, a bullish or a bearish, yes, we are on two sides.
If I ask both of you what you'll do today, probably it's a very thin line. But I'm saying from a slightly positional point of view, you're bearish, you're bullish.
Yeah, on a long-term trend, I will say that on the risk-reward matrix, we are probably at a lower end of that. And below which, once that breaks, you open up big downsides once that happens. And as I said, over the last 1.5 months, we've been maintaining. It's not breaking. I also want to be bearish, but it's not breaking. The fact of the matter remains that you are not breaking either downsides, neither you are breaking phenomenally into upsides. So let the market decide and just trade small 30-40% of your capital, either a bull or a bear. You can't trade 100% of your capital right now. You have to wait for a confirmation, or either you break out on the upside or the downside to take aggressive trades.
On the downside, what are you saying in terms of what does the market need to do for you to actually start believing that there is a significant downside?
Once you break 5400, you will definitely be opening up for downsides. My chart that I have continuously showed at NDTV, I can show that once again. But if you can put that chart on the screen,
let's do that.
I will be able to explain it much better. And just to summarize the chart once again, what we started in 2003 from the lower bands. Once the bull market started, essentially you never broke below the bands for the entire 2003-2008 period, and you took multiple supports, almost 6 to 7 supports that you took on that monthly mean.
Right.
And now that level is now close to the expiry date. So if I have to shift my stance, it's a slow gradual shift. The level is at its expiry date. 4-5 months is the maximum that a monthly mean has held. So as in if you break this month 5400, then I think you are opening up downsides till the lower band, and the lower Bollinger bands right now are around 4700 levels. So the caveat now remains that the level which we were tracking for the last 4 months is about to expire. So the efficacy is going to go, and within this month, if you break 54, then you're opening up downsides to 47. Will it go all the way till 47? Then it's a step-by-step process, and then we'll try and trade that move as it unfolds. But 47 will open up the moment you break 54 on a closing basis, on a weekly closing basis.
Rohit, comment on that point.
Yeah, I mean, see, he's not wrong in terms from a purely trading point of view, because if you're looking for a higher probability trade, you would like the trend to confirm. I mean, when I look at the wave structure, I feel bearish. But should I short today? Okay, so there are different ways to deal with that. You may wait for the breaks to happen, which is 5400 or even 5300 to be really sure, and then actually act upon it, because then you have a clear 500, 600 point downside coming to you. Or do you start acting from the top itself with some amount of capital? Okay, so even from a trading point of view, how short would our stock funds be? We would be probably not more than 30% short at this point of time. So like you're saying, you wouldn't really go all the way 100%. Okay. But the view remains. I mean, see, when you're actually advising an investor, would I go and tell him to buy? The answer is no. The structures in sectors, say for example auto stocks, metals and banking, key three sectors, all of them have shown some kind of 5-wave decline in the recent sell-off, which means whatever bounces occurred in April was simply a corrective, and the next move down has already started. So it's just a matter of how much are you going to retrace this fall before you fall again? Is it going to be 38%? Is it going to be 50%? And then you fall again? You really don't know. So if you're advising longer term investors, I would say keep selling, because you won't get another chance. Otherwise you would end up selling 20% down, and then that would end up being a bottom. So that's my approach to looking at it, because I'm keeping the
20% down from here, you'd say would be a bottom.
You would get a short-term bottom. See, you're not going to go one way down in a bear market. You're not going to go one way down. You will hit 46, 47.
In a bear market.
Yeah, I am calling it a bear market. So you will get bounces, then you will fall again, then you will get bounces. It need not be like 2008 where the sell-off was, vertical
and straight.
You might get something which is like a waterfall, falling each step, bouncing a little, falling another step, bouncing a little. And if that happens, then there will be opportunities to trade the long side from a 1-2 month perspective from time to time.
Sarvendra, you're not calling it a bear market, are you?
Not till now, but if 54 breaks, then you are into some kind of a bear market decline. How?
If 54 breaks.
If 54 breaks, then I said initially, as he rightly said, you go step by step. And I taking a slightly shorter term trading kind of a call, 3 to 6 month kind of a call, I would first look for 47. If that breaks and if these bands start to expand, then you would start opening up downsides.
The difference between a bull and a bear market, you can define it any which ways, but 100 point odd change from where we are right now, that it? To categorize it between a bull and a bear market, there's got to be other factors for you to call it a bear market, right?
Yes.
And not just 5,400. There's more to it.
Yeah, there are ways some people classify a 20% fall from the top as a start of a bear market. It differs, and we being eliticians, we would be probably looking at more of the wave nature and the wave structure to call it a bear market or a bull market. So right from 80 to 100 onwards, I have kept the faith and kept the belief that what has started is some kind of a fresh move, and I would be looking in for retracements of that. And I could, if I look at a 61% retracement for that entire move, you could get levels all the way down till 4,000. But the moral of the story is that you have, if at all they are there, and that's not a view, if all those downsides are there, it would be a step-by-step process. And we will trade that every passing month. We will want to trade that.
Right.
I'm just going to get Neeraj in to the conversation as well. Neeraj, help me out here. What are the fundamentals of this market looking like? We've got two differing technical views, but from a fundamental standpoint, is the bias positive, negative, neutral?
Yes, yeah. When you look at technically, I think the market is definitely in a very narrow range, and volumes are also pretty low right now. There seems to be lack of interest. But when you see the prices compared with the valuations, I think prices are at attractive levels where you see a lot of stock-specific attractive valuations there in across sectors. I think it makes sense, according to us, to be invested into the market. Market is definitely waiting for a direction. I think the minute you get some sort of indication that interest rate cycle is peaking and commodity correction is happening, I think now you've got even indication as far as the monsoons are concerned. Monsoons are coming. They are in time, and I think little ahead only. I think definitely you should be invested at least 70-80%. Worst case, I think whatever you saw recently, 53.50 kind of a level, I think that will price in most of the negativity which is already there in most of the stocks. I think better to be invested at these levels, and maybe a small dip or whatever dip you get, and you have the RBI meeting again next week. You know, you can get some sort of indication from there what the RBI is thinking about inflation, which is very important for us domestically. I think some indication of some peaking happening in the interest rate level and inflation, you know, coming down slightly. I think we are looking at positive markets ahead then.
You know, Neeraj, the problem there is that, for instance, you talked about commodities. Now, oil prices have come off a little bit. WTI crude was below 100 overnight. And there's an indication at least that maybe they won't collapse from here, but they don't look like they're going in one straight line up. As far as inflation is concerned, I think the view is pretty well known. The first half of the year is going to be high inflation, and after that it will come off in terms of interest rates, 50 to 75 basis points. I don't think anybody differs from there. So why would those be fundamental factors that would drive the market right now? Wouldn't there be something external, something perhaps that we don't have in the realm of our thinking that would break this market out one direction or the other?
I think it's more as a matter of time how things fold in. Definitely, you know, globally also factors are important. We saw again some Europe crisis coming into the picture. I think how people are going to get out of this QE in US is also very important. So we have to really look at end of June, July, how that is happening. So that's why I think it's a couple of months where all these things will really come in front of us. Markets normally, you know, are trading ahead. And so I think immediately when you get some indication, well, things are actually happening. So RBI next meeting next week is important because of that. We need to get some direction there. I think once they start talking that they are having things slightly under control, I think valuations are attractive. So why I like to be invested, I don't want to sit in cash in this kind of a market. I think these are opportunities between May, June, early July. I think this is the time to invest.
So what's the expectation now? July will get from the RBI another
June.
June.
Yeah. I mean, the expectation is you'll get another 25 basis point hike.
25.
If that doesn't happen, I would tend to agree with Neeraj that maybe you know, they're starting to get a little bit of a comfort in terms of the inflation numbers, but there hasn't, and not at least numbers that have come out haven't shown a dramatic change.
And it's pretty well known, 25 basis points you'd get that.
That's the consensus view in the market.
Rohit, just in terms of how, you know, you were talking about something external, right? When you meant external, I understand you meant something out of the market, outside of the market itself.
That's right.
So all these factors are known now, politics and this and that and interest rates and inflation. At least we perceive it to be known. Can it so happen that still the market might react wildly to something which is very well known, say you know, an interest rate hike of 25 in June or any of these factors which we perceive to be very well known? Could that be the break point, the trigger point?
Definitely, if interest rates continue their way up, it could be. If inflation bounces back, it could be. So those again continue to be external to the market. And what is internal to the market is valuations itself. So if you purely look at valuation, you look at a level, you see supports, you say, okay, these are basic factors which should support the market. But when you look external, it could be anything. Inflation spiking.
No, I'm saying, like you were saying, the 25 basis points is expected. That's the consensus expected. RBI does 25, and the market suddenly wakes up and says, "Wow, this is bad." Could that happen? Or no, it's pretty much built in.
See, sometimes I'll tell you what happens from an Elliott wave perspective. You know, news always follows the market. That's what we've learned. When the markets turn down, then you come to know what's the bad news. There's a whole reasoning why that happens, why socioeconomic events actually occur after the markets, because behavior usually shows up with a lag in terms of economic data. Okay, how will the market react at that point of time? It might not be related, you know, if you get deeper into that part of the theory. It might just not be related. The market may have fallen because of reasons of its own.
And we might just attribute,
that this was the cause or effect. But if you look at the overall scenario, what risk can I see right now? I think the biggest risk I can see now is probably from global markets, essentially from Europe. If you look at most of the European charts, they've all broken trend lines, all their weekly momentum indicators have gone into sell. So they're rolling over one after the other. They're not happening all at the same time. But Greece, followed by Spain, if you look at the Spanish market, followed by Switzerland, each of them have started falling one after the other, which simply the markets there are telling us that something negative is likely to happen. We've already heard a lot about what might happen, you know, about Greece. But there probably is more to it, why all those markets are reacting one behind the other.
Yep.
Rohit, are there any sort of clear sectoral biases with which you're trading?
Yeah, I did mention that I can see clearly auto and metals. I think these two sectors I can clearly see showing weak momentum over the last couple of days and likely to, I think, continue. So these would be two sectors that I would probably be short on at even this stage.
Autos and metals.
Sarvendra, any sort of sector? Do your sectoral calls agree with his at all, or?
See, these two sectors definitely look to have some kind of a short-term, medium-term reversals in place. So those two sectors, in fact, metals is a sector that I have also been negative on for the last 4 to 5 months now. And as I said, that call comes from the view that we carry on the DXY or the dollar. And there, I think a fairly long-term bottoming out process is in place. And once that completes, probably in the next 10 to 15 days, I might also shift camps and want to short the market. So 10 days and probably I would be shifting camps.
But Sarvendra, looking at global markets, I mean, if you look at S&P weekly chart or S&P monthly chart, look at Nikkei, look at even Russell 2000, even that has started underperforming the US, other indices in the US over now. I mean, doesn't it look like that, again, S&P has, as of now, topped out at the 78.6% of the entire 2009 to 2011 run. So, I mean, doesn't it look like that global markets are melting down? India, having corrected first in this leg of the rally, probably just is waiting for that confirmation to come, and then we break down. So 5400 is not if, but just when.
Yeah, probably yes. If it's not an if and when, then you would see those clues coming from the international markets. And I carry a chart of the Dow Jones today, if you can put it there.
Yeah.
That also broadly confirms what Shakti is saying. Those markets have started to, this was the strongest technical market, and this market has also started to crack. So yesterday's move, it does not have the bar for yesterday, but it has broken below that blue 52-week channel. So that break is definitely there. So breaking a 52-week trend channel tells you that the market could easily go down into a 3 to 6 month kind of a down spiral. So if you have to put lower targets, first target on the green channels would be coming at somewhere around 11,500, and if that breaks, then targets in the region of 9,500 are also very much possible on the Dow Jones. But I was expecting one final move and completing that red bearish wedge for the index. But now that alternate is now getting swept on the carpet every passing day. So this was a view that we carried for quite long, for a couple. I carried this view for a couple of days back. But now with the break yesterday, I think this view is out of the window, and what you would be now looking at is that you would first be looking at 11,500, and once that breaks, you will be looking in for much lower targets on the Dow Jones as well. So international markets are definitely giving you jitters right now, and all have completed, as I said, the Fib ratios, be it a DAX or a FTSE or a CAC or a CRB commodities index or Dow Jones itself, S&P, both have had, all these indices have got very good Fibonacci ratios in whatever they have done till now in the pullback, be it their pullbacks, be it their wave structure or their wave equality. So looking at that, definitely a sign of concern. Once those start cracking,
Sarvendra is already getting converted.
Shakti has converted me.
The power of having everybody in the studio.
So amongst 4 bears, the bull is getting converted. So 10 days window period. As I said, this month is a window period on the monthly mean also.
Right.
That level is at its expiry date. So that expiry date is near. If now you break it, no whipsaws allowed now. If you break it on a closing basis, you're gone.
You're gone. That sounds dramatic. So what?
4,700, as I said, the downside will open on the monthly mean. If this time, last 4 months I was allowing whipsaws 1 to 2%. This time I'm not allowing any whipsaw, any weekly close below 5,400. The market is going down.
No, for a bear, this recent volume is a little concerning. If you are short and you don't see the market fall, and you're not seeing selling, because even when it fell in April or in Jan, each fall came with a lot of volume. You definitely feel a little scared because if you get a bounce back, then you're
selling
on the wrong
and
side.
Staying short.
Staying short. Every day you worry about it, because why isn't the volume and selling coming? Even though you're seeing the breaks in other markets, you're not seeing it happen here. So that's probably the key reason why you'd still be a little on the back foot on your bear stance from a trading perspective.
Does that itself tell you something about whether you should sort of be a little more flexible for allowing the market to do something on the upside? The fact that the market should sell down, all these factors are pointing to it, but it's not.
Okay, I'll tell you, there are 2 occasions, because you are looking at multiple factors, so there are like 10 factors and this is one. But there are 2 times when I've seen this kind of pattern. One was in 2001, before 9/11, a month or 2 before 9/11 happened. Those 2 months were extremely painful, because the index Nifty was barely in a 50-point range, or maybe even smaller, because you are back at almost around the 1,000 level in terms of Nifty. And there was no liquidity, no volume, because Badla was banned, so there was no position. And even though the charts look showing there's a C down happening, it took more than 2 months of waiting period for it to actually play out and an actual event. The same thing repeated again in 2004 when the market stopped at around 6,000 on the Sensex. And you got the deep correction only after the election results happened. But till then, which means from January all the way to May, for 3 months, the index was simply in a 100-point range, jumping between 55 and 5800, not giving you clear direction. Volumes dried up. By the time it was April, positions also went out of the market. So people would tell me, why will it fall? There's no position. And it finally took an event for the correction to happen. Okay, even though there were no positions in the market. So those are 2 periods where you saw that kind of a scenario.
You want to talk about RIL, Sarvendra?
Yes.
You had a chart going, right? Let's put that up on the screen. RIL.
So this is one stock that was the cause of concern. This is one stock that was supporting my bull market case. But now over the last week or so, this is one stock which has broken below a 10-year trend support. This is a 10-year trend channel on the stock. In fact, more than 10 years. This started almost in late 1999. So once you do something like this, and a heavyweight like Reliance, if it is breaking below 10-year supports, it does not. It's a sign of concern. So you would give it, say, a couple of weeks to recover, if at all. If I just zoom in the chart, and if you can see the recent price action from the Feb lows at around 885, once it recovered, it was showing signatures that yes, this bull market channel would hold and eventually prices will go higher. But it's a big disappointment to see Reliance has broken that. And the pullback a couple of days back to 967 was just on that trend line. It just pulled back to the blue trend line and started to sell off again. So that's a sign of concern. And if it starts to trade below 880, which it has no business to do right now, if it does that, then as I said, 54 will break on the Nifty. And since it is such a widely held stock, you don't know what will happen after that. Once levels which are not seen in the previous 2 years, they start coming, the kind of psychological effect they can have on fund managers who are overweight on Reliance. And if that selling emerges, then you are going first to the red channel, lower end of the red channel, which is around 760. And if that breaks, then I don't need to...
That's slightly longer term. But essentially the takeaway right now for somebody watching would be, don't do what probably has worked over the last 2 years, which is basically once the stock comes to about 900, buy it. It again gives you a bounce.
Absolutely. 880, anybody holding Reliance for the short term, 880 is the stop loss. If it closes below 880 and if the volumes start to emerge there, then you can safely assume that the stock is initially headed for 760. And if that is broken, even lower. So this is one heavyweight which tells me that I have to shift cams. When I said I want to shift cams, Reliance is the stock that tells me that you have to shift cams fast if you want to be on the right side of the market. So 54 breaks and Reliance breaks 880, I am shifting cams, definitely.
What about Tata Motors, Sarvendra? I mean, that was one stock which probably has given support to the Nifty every time it was under pressure, right through over the last 2 years. Yesterday we spoke about it from 150 to 1300. Now that has broken down big time. Isn't that a bigger concern than Reliance? Reliance anyways did nothing for 2 years.
See, if I put the entire auto pack, they don't add up to Reliance weightage in Sensex Nifty. So what I'm trying to say is, yes, those was leaders, and a leading sector like autos and banks, if these 2 sectors, if they start to invert, then definitely those are signs of concerns and the signs of first weakness. And Tata Motors continues to be a stock which has now again broken below a 52-week. That stock also broken a 52-week trend support. So definitely the bias on the auto space is definitely on the sell side. But as I said, I was keeping my eyes on Reliance and SBI, both of them. Now these 2 heavyweights have started to look weak. And if these 2 are not holding, then Nifty is also not holding 54. So if SBI starts to break the recent low that it made, around 2160, if that breaks, and simultaneously Reliance breaks 880, then we are headed for troubled times ahead. And 47 opens, and then what opens, you don't know. Suddenly, when you start seeing rates which you have not seen in 52 weeks or 2 years, more than 52 weeks, what it can do on the human mind, you don't know. What fund managers will do, how they will allocate their assets after that, or what they want to trade after that. So you don't know. You open a Pandora's box below 47. Or 54, sorry. You will open up a Pandora box if you break 54 now.
Rohit, you've got some interesting calls. Apart from your sell calls, you've got one buy call on Britannia. We don't hear much about that one.
Yeah, we've seen some positive momentum in the FMCG stocks, and Britannia was one which I was tracking for some time. I don't have a chart to show, but it was on multi-year trend supports, trend channel lasting for almost several years, maybe more than 10 years. So when we look at something like that, then you're looking at some kind of bullish potential. It's possible, in a very wide market, if you're in a bear market, you'd get asset allocation to, limited defensive areas, and FMCG is probably one which I can think of. So it's possible that, some stocks in that space actually do well.
So Britannia could be among the list. I think we'd earlier seen ITC, lots of positive calls on ITC and HUL as well. Neeraj, just, what is on your stock-specific radar? You got PVR, Dish TV, anything specific other than that?
Yeah, basically in the large cap space also, I think banking now is looking very attractive with the kind of correction you've seen. State Bank for that matter, I think it's a good time to start accumulating State Bank. ICICI Bank is another good stock where you've seen last 2 quarters have been very good as far as performance is concerned. I think large cap will look at banking, and then even in the capital good space like BHEL, you had mentioned in your show some time back. I think BHEL, L&T, the kind of order book position that they have, I think it's just a matter of execution. And I think another 1 or 2 good quarters, and I think these stocks are looking very good. And plus, even we like Reliance also, though we like to see this quarter. The last quarter was not that encouraging as far as the GRM is concerned. That is one where they're making actual money. I think if you need to see this quarter results. I think post these June quarter results could be a good time to look at Reliance again. Though at the current levels, also valuation-wise, it is quite attractive. And I mentioned Dish TV PVR is because of the consumption pattern theory, where consumption here is happening, where people are shifting, their lifestyles are improving. So I think PVR, Dish TV, they are one of the stocks which we track also. We have a research report and we have buyer outperforming rating on them. So this is just an example I gave that these kind of stocks we are looking at where we think have a good scope going ahead, and the valuation is also quite attractive.
Just a quick follow-up, whether you look at media stocks or you look at, say, textile, all of these sectors have had like these short-term spurts, but they don't seem to last. So again, people are still looking at these also as trading plays. For instance, textile stocks went up because cotton prices had come off dramatically. I'm not sure why yesterday media stocks were buzzing. We didn't really pick up any specific news flow, but it tends to last a day, 2 days at the most. Trading again, no sort of investment plays coming in.
Yeah, if you see, last couple of quarters now, market has become more like a trading bet. You saw a peak in October, November. After that, market has been, quite lackluster, but trading bets are happening. Investment is not paying for the last, so many quarters now. So because investment is not paying, people are like entering, exiting, just trading in the stock. But I think it will be a better strategy now to look at pure investments also, because valuations are very attractive and you need to change your stance from pure trading to investment also, where there's so much lack of interest right now. No one wants to put in more money. Whatever little bit of money they have into the system, they want to just play with that money and keep trading. So I think you have to change, and this is a time where you need to do some stock specific buying also.
Okay, so Neeraj is bullish there. Here there's too much of...
It's the Delhi-Bombay divide.
But Rohit, from a slightly, and Sarvendra jump in on this one as well, from a slightly longer term time frame, we talked about global markets, global charts looking, you throw in, the more analysis that you throw in, a lot of times it gets more confusing rather than anything else about what you want to do. My point is over say the next 18 to 24 odd months or so, if you want to have exposure to stocks, what would you do right now if you had that kind of a time frame? Would you look at all this noise and or rather cut all this out and say that, well, I think it's not so bad?
My call is pretty clear. It's bad.
Okay.
It's
even
bad.
From a 2-year
From a 2-year perspective, it's bad because when I say it's a bear market, the risks at a stock level tend to be extremely high. I'll give you an example. We used to discuss real estate stocks a year back, and it's the weakest sectors remain weak. And if you look at their performance, they're off 70–80% from the peak. And what I'm saying peak is the 2-year peak, and not even the all-time high. And so if you had exposure to real estate, if you had exposure to infrastructure, okay, these sectors completely didn't do well. if you had exposure to a lot of mid caps, they've all been making 52-week lows. One half segment of them have been doing that. There's another segment which hasn't. So the distribution in the market has happened at a stock and sector specific level and not at the index level, which is why the index is still at 18,000, whereas stocks have already fallen 50, 60, 70, 80%. You know, so that is why, just like he was saying, that portfolios have not done well for several quarters on an investment basis, so people have started trading. The reason for that is the same, that an average portfolio which is highly diversified would end up having stocks in sectors which are not performing, and therefore the portfolio as a whole would not be performing, even though you may have had some banking and technology stocks. Okay, so that is why investment can only be made in an environment where you actually see a reversal of that process, where you see accumulation, bottoming out processes from stocks to sectors, and then you will see portfolios start performing. You know, so I am still seeing a risk to that on the downside, and therefore I would not look at investing at this stage from a 2-year perspective also.
So you're saying the timing is wrong right now? That's what you're saying? Or
that's right. The timing is completely wrong for an investor because the risks are high. I'm not sure whether 4,700 is a final bottom or not. It's possible it could break. It's possible you could be at 4,000. It's possible you could be sub 4,000. You don't know that today. The risks are there. Okay, the direction is there, the risks are there, and therefore it's not an ideal time to do that kind of investment because the losses at a stock and portfolio level could be far greater than would be at an index level. You know, the same is seen, I mean, if you take one business cycle backwards, I think we are at the end of one business cycle. So the last business cycle for India was around 94, 95. The index then topped at around 4,500. It never went below the 2,800 or 2,700 mark. Okay, but if you were in sectors, if you were in industrial sectors which were highly leveraged, there was overcapacity in Indian steel. If you were in those sectors, some of them lost 80, 90, over 90%. There were companies that got delisted during that period. So it's not always an index risk. The risk you face in the market at a portfolio level is sometimes far greater than there is at an index level.
Sure.
Which is interesting because a lot of people have come on and said that, you know, don't do anything on the index, buy stocks, but, you know, that's the sort of valid point to make as well, that some of these stocks could have higher risk even at the, compared to the index.
How would you look at it?
See, there are ways to look at it. If someone is a buy and hold kind of a guy and he does not mind holding stocks 20-30% lower, that can be his call. But purely from, if you look at technical analysis, it's all about trading risk rewards, right? So once the risk rewards invert, and one thing is very clear in my mind over the last 3-4 months is that the medium term and short term trend is definitely down. All we are doing is that we are trying to find some support on the longer term support, so which have been dynamic themselves. So 4 months back, the monthly mean was around 52, and the monthly mean has now climbed to 54. That continues to remain my pivot point on the long term. So once you go below that, then there's no point holding to stocks. Then you will want to sell out, get that opportunity cost, 20-30%, whatever, or 15% even. So you will get that trading move, and that's an opportunity cost. If someone wants to capture that 15-20%, he should be trading. He should be selling out, and if at all he's a kind of an aggressive trader, he could be willing to go short as well on the market. So, and vice versa, if 54 holds, then he would start building his long-term portfolio slowly. So that slowness would start at 30%, as I said. Right now you'd be 30% invested, and then you will slowly build onto positions once you are in profit. It's a gradual process. Being illitations, once I am counting a 5-wave up, once that gets over, the confusion starts. Within a corrective wave, the confusion starts for analysts in terms of where we are headed and what could be the targets. As long as we are in a trending move or we are in an impulsive move, either up or down, there's a lot of clarity. So 1.5, 2 years back, it was absolute clarity when the election results were there, and that entire move we definitely caught. But that clarity is no longer there. So that is where you are trading less, you're reducing your position size and trading. And then, as I said earlier as well, not only taking technical analysis for view, not only taking technical analysis for trading, but also managing risk along with that. So once your short-term trend is down, you want to be 20% cash. I'm just giving an example. Once your medium-term trend is down, you want to be 40% cash. Or 50%
54
cash.
holds. I'm saying irrespective of what happens, and looking at what has happened to global markets, do you have the conviction to say, I don't care what happens to global markets, I've got the holding capacity 15% lower, 20% lower. Can you say right now that you're, and you're not saying it's a bear market, so right. you get a big move up?
Yes, absolutely. So as I said, with the 30% investment, you are keeping 54 in mind and wanting to trade long. But if that breaks, then as I said, being a technical analyst, you have to...
You're sounding more bearish now than bullish now.
So as I said, no, my reversal levels, my levels are close to their expiry date. And Reliance is a big stock that is underperforming. SBI is a big stock that has started to underperform. and I have to live with the times. I don't want to get butchered in this market. So there's no point being optimist when the charts are telling you that the long-term trend itself is inverting.
Yeah, jump in here, yeah. With some GDP numbers or something. So much bearishness.
Why would I spoil the party?
I'll find you a headline.
In fact, I found myself thinking for a minute that I need to get a book on technicals, and then I quickly stopped myself.
I'll get you a headline. You know.
I can flip 4 charts and you can see that things are still not that bad. You could still have a chance of, as I said, you could still survive these times and probably hold 54 and then move higher. So
I'm sure
but no,
we'll all survive
hold
these
54
times.
and survive and just grind and do nothing.
No,
that's not my
if
point.
I was so clear, I would be trading 100% of my capital.
Right.
I'm just trading 30%, so I don't have a clarity for the next 18
But I
months.
told you got a 2-year horizon.
I don't have a clarity for the next 24 months right now. That is why I'm trading 30% of my capital. The first time it came to the monthly mean at 5177, I was 100% invested. But that level is now expiring. So there's no point holding on to those positions.
Okay. All right. We'll take a break here. Thanks very much, both of you, for coming in.
Fantastic.
Great having
discussion.
both. Appreciate it.
Neeraj
Neeraj is in Delhi as well. Neeraj, thanks very much. Hope to see you in the studios next time. Sorry to sort of gone completely technical and charged today. Thanks very much. Shakti, thanks as always.